I just want to say I don't have a bone to pick with anybody as I bring you these sort of red flag videos when I look at the economic data out there. I do have skin in the game, just like the rest of you watching this video. So when I share some of these economic red flags, as I'm calling them, I'm just literally pointing out what's actually happening out there, and you can do with this information what you want. You invest your portfolio how you like. Now, this morning, though, we got 3 more red flags from both sides of the border. And if you care about where the economy is headed, I suggest you probably should be. You're going to want to pay attention. Now, Canada's factory activity just hit its lowest point since 2023. And in the US, we saw job openings falling, while manufacturing also slipped back into contraction. So these aren't just numbers to me. They're actually signals. These signals about jobs, trade, inflation. So let's dig into the latest reports, see what they're really telling us, and what I would say why they matter. So let's start here in Canada. And our manufacturing sector took another hit in March. This one's got some pretty serious weight behind it as well. The latest S&P Global PMI numbers show a deeper contraction in factory activity, and it's the worst reading that we've had since the end of 2023. If you're wondering what all that means for jobs, for trades, for the overall economy, I'm going to break that down here. So the headline number this morning, the Canada Manufacturing PMI dropped to 46.3 in March. That is down from 47.8 in February. And anything below 50 signals contraction. So this drop shows not just a continued weakness, but this is an accelerating decline. We don't want to see that. The manufacturers, they reported that customers are getting more cautious, especially when it comes to buying from across the border. You can probably guess why there. It's the ongoing tariff uncertainty between Canada and the US, and that is scaring off buyers. New export orders just saw the steepest decline since May of 2020. Yes, the early days of the pandemic. And with fewer new orders coming in, companies are holding back on hiring. Instead of replacing people, they're just sort of letting those positions go unfilled. And that has led to another drop in employment levels across the entire sector. Now, on top of that, we have input costs. They're rising quickly. Inflation for factory inputs, that is hitting the highest level now since the summer of 2022. Again here, tariffs are the major factor. They're raising prices and squeezing margins. So let's look at what this all means. Well, the way I see it here, we've got rising costs, we have falling demand, and that could ripple out into the broader economic performance. That's kind of what I always think is the biggest threat out there, is when it spreads across the entire economy. And if production continues to shrink, if the firms that we're seeing today stay pessimistic, that might affect the overall GDP growth in the coming quarters. Now, when we look at the Bank of Canada, the policymakers, this kind of slowdown absolutely complicates things. The bank here, it's been watching for inflation, it's been watching employment trends, and if the manufacturing continues to weaken, that might strengthen the case for interest rate cuts later this year, but only if they're able to keep inflation under control. They're conflicting, they're going in different directions and butting heads there. So no doubt, at least through my eyes, this report does paint a rather gloomy picture, but is it the whole story? Well, on one hand, it's clear that the tariffs are having a major effect, but then when you look at the other hand, this is just a single month snapshot. We always have to keep that in perspective. It might just be a temporary dip. The initial PMI numbers often get updated. So when we look ahead here, I'm not feeling overly optimistic about the manufacturing numbers. We also see business expectations for the next year. They've fallen quite a bit. And honestly, unless we see the trade tensions ease and quickly, if we see demand pick up, we might be stuck in this sort of low gear cycle for a little bit of a while here. And also, I think if the export orders don't recover, we could see more job cuts, even some plant closures, especially in the sectors that rely most heavily on U.S. trade. So what do you think? Do you think this is a short-term dip, or is this the start of something more serious? Let me know in the comments below, especially if you're in one of the industries that is most affected. Now, I want to move now to south of the border, and we have some new economic numbers out there as well. And frankly, they too are not very great. We have 2 reports out this morning, both with red flags about the U.S. economy. We have fewer job openings and a surprising slump in manufacturing activity. So let's break it all down, what this might mean for the road ahead. First up, job openings. According to the latest data from the Bureau of Labor Statistics, the number of available positions in the U.S. dropped by nearly 200,000 in February, came in at 7.568 million. And that's not just below January's revised number of 7.762 million. It's also missed market expectations. Consensus had that number at 7.63 1.3 million. Now, at the same time, the new ISM report shows that manufacturing slipped back into contraction in March, with the PMI falling to 49, down from 50.3 the month before. And that might not sound like a huge drop, but it has crossed back below the 50 mark. And just like in Canada, that does show contraction. And that comes after a couple of months of the number coming in above 50. So that is a signal of shrinking activities. So I want to zoom in now on those numbers. Let's start with jobs. Openings declined across the industry. So we saw finance numbers drop. We saw manufacturing numbers drop. We saw trade, transportation, and utilities numbers drop in the US. And retail alone lost 126,000 job postings. So that to me is not exactly a sign of confidence as we head into spring. Geographically, this is a nationwide story. Job openings were down across all 4 major regions: the South, the Northeast, the Midwest, and the West. Meanwhile, hiring and total separations interestingly stayed relatively flat, 5.4 million versus 5.3 million. So this includes quits, layoffs, and discharges. So people aren't getting hired or fired at a faster pace, but there are certainly fewer seats at the table. Now, I want to shift back over to manufacturing, see what those numbers say. As I say, it's not looking much better there. New orders fell sharply, down to 45.2. That falls from 48.6 in February. That is a clear sign that demand is slipping. Employment in the sector also took a hit, down to 44.7. That points to ongoing layoffs or hiring freezes. And even the production numbers dipped here. Now, one bright spot I see is inventory, but that could actually just be a symptom and not an actual solution, as we see companies perhaps stocking up and not necessarily selling more. What does this all mean? Well, fewer job openings plus those slower factory activities, that could be early signs that the economy is losing momentum. That's the way I'm seeing it. If hiring slows any further, the Fed's job just got a lot more complicated. Inflation, still a concern, especially with the price pressures that we're seeing in manufacturing. They now spiked to their highest levels since June of 2022. But we're also seeing cracks in the demand with labor and industrial output. Again, that puts the Fed in a really tough spot. Do they hold rates steady to fight inflation, or do they start considering more cuts to support growth? You know, that's a really sticky, a really tricky situation there. So all in all, this report feels to me like it is a real reality check. Yes, the job market has been fairly resilient recently. Yes, manufacturing did show some life earlier this year. But when we look at things today, I am seeing signs that companies are pulling back. We're seeing fewer job listings. We're seeing shrinking factory orders, falling employment. That doesn't exactly scream soft landing to me. If the demand does continue to falter and we see the companies reducing those job openings, there could be more pressures on the labor market, and it could possibly ripple across the entire area, and most importantly, probably into consumer spending. And if we see inflation remain sticky at the same time, that is a very, very tricky combo. Now, obviously, the next few months are going to be critical. I will be watching to see whether this is just a pause or whether the start of something deeper. That's what I think it is, but I'd like to know what you think. Let me know what your thoughts are in the comments. And don't forget to like and subscribe for more breakdowns like this. Now, that is all for today's report. If you want to learn more about DIY investing, I will put a link here on the screen for our Investing Academy. You're always free to check that there. As always, thank you so much for watching. We'll see you in the next video.